It's earnings season again. We have finally kicked that off. We have seen financials today rally, really despite the fact that it was a mixed bag for those bank earnings. This GTV chart on the Bloomberg showing how financials seem to have broken out of their trend. I do wonder, though, given that we're in this Fed easing cycle, can you really fight the Fed?
Well, there are plenty of people who are concerned about the impact of lower net interest income on banks, but we do believe that's probably discounted when you look at the valuations of banks, and the action today is a good example of that. Many people went into the earnings season, I think, expecting almost an earnings recession, and we think that was way too pessimistic to expect one, let alone 2 quarters of negative year-on-year earnings growth. The quarter-on-quarter growth for Q4 should actually be a pretty easy comp to beat. And the negative expectations from the flat to lower yield curve is probably discounted in financials. And so when you have strong earnings come in from firms like JP Morgan, it positively caught people by surprise, without doubt.
But when you're in this lower for longer rate environment, where do you go searching for yield? What are your thoughts on where we could find the best value and the most attractive sectors?
Well, we are looking for high-quality companies and those that are interest rate sensitive in particular. So we like global REITs, global listed infrastructure. That's where we're overweight. But more broadly, we still favor U.S. equities, high-quality U.S. equities that have good business models, that have very impressive positions in their industries, such as JP Morgan, are absolutely the place to be. In this lower for longer, lower growth environment, it's not an environment that's forgiving for all companies. You really have to think about those companies that have dominant business models and that can survive and thrive in a 1.5% to 2% growth environment versus a 2.5% to 3% growth environment, which is good for everybody. But that's not the case we're expecting for the next several years.
Bob, for the first time in a while, we saw US markets trading higher and kind of putting the trade issue on the back burner in the session that we just had, and also, interestingly, reacting to positive news flow coming out of Brexit as well. I mean, is this just a bit of, I guess, fatigue from the big headlines, or is the market being kind of range-bound for a while, looking for a reason to break out in this late part of the cycle?
Well, we're modestly overweight risk across our multi-asset class portfolios. And the risk for investors is that they focus too much on the risk scenario as opposed to the base case. The base case for the next year, in our mind, is that the U.S. does not have a recession. It grows about 1.8 to 1.9%. Earnings remain low. The Fed remains accommodative. You're in this global easing cycle. Earnings grow at mid-single digits. That's not a really bad environment at all for risk assets. And so when the bad case does not get realized, that is, there's a temporary truce in trade, Brexit doesn't seem to be falling apart, it shows that there's upside risks to this market as well. People keep on waiting for something to go wrong. And they're not thinking enough, in our mind, about things going right or things even being okay. And then they forget that before they know it, U.S. equities are up over almost 20% for the year. And that's a big miss.